December 30th, 2025, started like any other trading day for silver investors who had watched their holdings climb 166% over the year. The atmosphere was celebratory. The precious metal had been the undisputed champion of the commodities complex, outperforming big tech and even most cryptocurrencies. But by lunchtime in New York, the celebration turned into a slaughter. In a matter of mere hours, silver plummeted from its record high of $86.62 per ounce down to $72. It was a staggering 8.7% crash, the single largest one-day collapse since February 2021. Imagine being a silver holder that morning. You watched thousands of dollars evaporate from your portfolio before you even finished your afternoon coffee. The panic was palpable on trading floors and digital forums. However, if you looked for a reason in the headlines, you found nothing. No global war had broken out. No major silver mine had suddenly discovered a mountain of new supply. No central bank had made a shocking interest rate announcement. The industrial demand for solar panels remained at all-time highs. The supply deficits that analysts had been warning about were still very real. In fact, the fundamental reasons that drove silver to its record highs just 48 hours earlier had not changed at all. This lack of fundamental news is exactly what should grab your attention. When the best-performing major commodity of the year sheds nearly 9% of its value in a single session without a catalyst, you are not looking at market forces. You are looking at an execution. Wall Street analysts quickly scrambled to explain the move as normal volatility or profit-taking after a monster year, but those explanations were nothing more than a smokescreen. If you have been paying attention to what happens behind the curtain of global banking, you know this crash had everything to do with a specific calendar date that 29 of the world's largest banks had been dreading all year long, December 31st. The crash was not random. It was a required mathematical adjustment. We are witnessing a phenomenon known as window dressing on a global, systemic scale, under the final implementation of the Basel III banking regulations, which fully took effect earlier in 2025. The world's most powerful financial institutions face massive penalty calculations based on the size and risk of their balance sheets on one specific snapshot day. That day is the final day of the year. The larger their exposure to certain assets at midnight on December 31st, the more capital they must lock away in reserves for the entirety of the following year. Silver became the primary victim of this regulatory gaming because of how it is traded within the banking system. For decades, banks have used paper silver contracts to manage their books, but under the new rules, these positions became a liability they could no longer afford to show. On December 30th, the banks were not selling silver because they lost faith in its value. They were selling because they were legally required to shrink their balance sheets before the clock struck midnight. This artificial selling pressure created a temporary vacuum in price, a trap designed to shake out weak hands before the regulatory reset on January 2nd. To understand why the silver market fractured on December 30th, we must look at the regulatory architecture known as Basel III. Named after the city in Switzerland, these rules were designed by the Bank for International Settlements to ensure that global banks would never again face a 2008-style liquidity crisis. While the public hears about these rules as boring accounting standards, for the silver market, they represent a total reclassification of what is considered money and what is considered a liability. Basel III created a clear, unforgiving hierarchy of assets that changed the game for every major bullion bank in London and New York. Under these rules, gold was officially promoted. It is now recognized as a Tier 1 asset valued at 100% of its market price. This puts physical gold in the same category as cash and government bonds. For the first time in modern banking history, gold is officially money in the eyes of global financial regulators. However, silver was left in the cold. Specifically, paper, silver, the derivative contracts, futures, and unallocated positions that make up 95% of the daily trading volume became toxic. Basel III requires banks to hold significantly more capital against these paper positions because they are now viewed as high-risk liabilities rather than stable assets. This creates a brutal mathematical choice for the 29 global systemically important banks, or GSIBs. These institutions, including giants like JP Morgan Chase, Goldman Sachs, and HSBC, must calculate their capital adequacy based on their balance sheet size on December 31st. If a bank holds a massive position in paper silver on that snapshot date, the regulator treats it as a leveraged bet. The bank is then forced to set aside billions of dollars in extra capital as a buffer. This capital is essentially dead money. It cannot be loaned out or invested to generate profit. For a profit-driven bank, holding paper silver through the new year is like paying a massive fine for the privilege of staying in the trade. The research published by the European Central Bank and the Bank for International Settlements confirms that this is not a conspiracy theory. It is a documented behavior called regulatory gaming. The data shows that global banks routinely reduce their repo market volumes and derivative exposures by up to 25% in the final week of December. They are cleaning the house to look as small and safe as possible for the regulators. Once the clock strikes midnight and the snapshot is taken, the pressure vanishes. This is why the crash on December 30th was so sharp. It was the final, desperate push by banks to dump paper silver off their books before the reporting deadline. But there is a catch that most retail investors missed. While the banks were dumping paper contracts to manipulate their balance sheets, the rules for physical silver are different. If a bank owns physical silver that is fully allocated and stored in a secure vault, it does not carry the same heavy capital charges as paper silver. Basel III is effectively forcing the banking system to choose. Either own the physical metal that you can actually touch, or exit the market entirely. The loophole they are hiding is that they can no longer use infinite paper leverage to suppress the price. The December crash was the last gasp of the old paper system trying to manage a transition into a world where physical reality is the only thing that counts. The price crash we witnessed on December 30th exposed a structural flaw that has remained hidden from the general public for decades. It is what insiders call the leverage crisis. Most investors believe that when they buy silver through an exchange or a bank, there is a bar of silver sitting in a vault with their name on it. In reality, the modern silver market is a tower of paper promises built on a tiny foundation of physical metal. This is the 300-to-1 illusion. For every single physical ounce of silver that actually exists in COMEX warehouses or London vaults, there are roughly 300 paper claims floating around the financial system in the form of futures, options, and exchange-traded funds. Think about the implications of that ratio. If you own a silver derivative, you are technically sharing your claim on a single physical ounce with 299 other investors. As long as everyone is happy to trade digital digits on a screen, the system functions perfectly. But Basel III has introduced a fundamental change in the rules of the game. By increasing the cost of holding these paper claims, the regulators have inadvertently started a game of musical chairs. When the music stops, 300 people will run for a single chair. In the silver market, that chair is a 1,000-ounce delivery bar. The banking system has relied on the assumption that investors will never ask for their metal all at once. They call this fractional reserve bullion banking. However, the data from late 2025 shows that the smart money is no longer willing to play this game. According to COMEX delivery data, 60% of all registered silver inventory was claimed for physical delivery in just 4 trading days leading up to the end of the year. This was not retail panic. This was institutional movement. Major players were looking at the 300-to-1 leverage and realizing that if they did not convert their paper promises into physical metal immediately, they might be left holding a worthless contract. When a bank sells silver to suppress the price, as they did on December 30th, they are usually selling silver they do not own. They are shorting the market using borrowed paper. In a world of 300-to-1 leverage, this is a dangerous game. If the buyers on the other side of those trades demand physical delivery instead of a cash settlement, the banks face a systemic failure. This is exactly why the price had to be driven down so aggressively. By crashing the price, the banks were hoping to trigger stop-loss orders and scare investors into selling their positions, thereby reducing the number of people who could demand physical metal during the year-end snapshot. We are now entering a phase where the paper market is losing its ability to control the physical reality. When the leverage is 300-to-1, even a small increase in the desire for physical possession can cause the entire pricing mechanism to snap. The banks are hunting for silver because they know the game of paper suppression is reaching its mathematical limit. They are trying to close their short positions and secure physical bars before the rest of the world realizes that the silver they think they own only exists as a line of code on a bank statement. The illusion is fading, and what remains is a desperate scramble for a metal that is becoming increasingly impossible to find. The most objective way to measure the silver crisis is to look at the movement of the metal itself. While analysts on television debate price targets, the real story is written in the ledgers of the world's most secure warehouses. The data is undeniable. We are witnessing the Great Vault Drain. According to official COMEX data, registered inventories, the silver that is actually available to satisfy delivery demands from investors have collapsed from 346 million ounces in 2020 down to just 82 million ounces today. This is a 70% decline in the liquid supply of silver in just 5 years. To put this 82 million ounce figure in perspective, consider the scale of global demand. The silver industry consumes more than 1.2 billion ounces annually. The entire remaining inventory at the world's largest commodities exchange now represents less than 7% of annual global consumption. This is not a comfortable safety net. It is a critical shortage. Imagine a grocery store that usually stocks enough milk for a month, but suddenly the back room only has enough for 2 days. That is the current state of the global silver market. The system is operating with no margin for error. What happened in the final days of December 2025 was the most alarming chapter of this drain. In just 4 trading days, 60% of that remaining registered inventory was claimed for delivery. We are talking about 49 million ounces of silver being flagged to leave the vaults in less than a week. This massive exodus of metal suggests that institutional buyers are no longer content with paper profits. They are moving their wealth into private, allocated storage where it cannot be touched by the banking system's accounting tricks. They are essentially staging a bank run on the silver market. This drain is not limited to New York. The London Bullion Market Association, which oversees the largest silver vaults in the world, has reported that their silver stocks have dropped by 40% over the past 2 years. In the East, the Shanghai Futures Exchange has seen its registered silver stocks drop below 300 tons, the lowest level since 2015. When you see a synchronized disappearance of metal from New York, London, and Shanghai simultaneously, you are not looking at a local anomaly. You are looking at a global scramble for a finite resource that is being consumed faster than it can be pulled out of the ground. The banks are hunting for silver because they are the ones on the hook for these deliveries. When an institutional buyer demands physical metal, the exchange must produce it or face a default. For decades, banks could simply move silver from the eligible category metal owned by private parties into the registered category to satisfy delivery. But as total vault levels continue to bleed out, that shell game is coming to an end. The 82 million ounces remaining is the last line of defense. If the current rate of delivery continues into January 2026, the exchange will be forced to implement emergency measures, which could include halting trading or forcing cash settlements at prices far above the current market rate. In the world of professional commodity trading, there is a technical signal that acts like a flashing red siren on a submarine. It is called backwardation. To the average person, it sounds like dense financial jargon, but to a seasoned economist, it is the ultimate signal of a broken market. Under normal conditions, commodity markets exist in what is called contango. This means that silver for delivery in 6 months costs more than silver for delivery today. This makes sense because you have to factor in the cost of storage, insurance, and the time value of money. You pay a premium for the convenience of having someone else hold the metal for you until you need it. Backwardation is the exact opposite. It occurs when the spot price, the price for immediate delivery, trades higher than the futures price. This is a massive anomaly. It means that buyers are so desperate to get their hands on physical silver right now that they are willing to pay a premium to skip the line. According to the London Bullion Market Association, when a market hits backwardation, it signals that there is a severe shortage of the physical underlying asset. It is a mathematical admission that the market participants no longer trust the future. They would rather pay more today because they are genuinely worried that the silver promised for tomorrow might never arrive. For the first time in decades, silver entered a sustained period of backwardation in late 2025. This happened right as the banks were dumping paper positions. Think about how irrational that is from a traditional perspective. The price on the screen was crashing due to bank selling, yet the premium for physical delivery was exploding. This decoupling is proof that the paper price and the physical reality are no longer speaking the same language. While the digital price was falling toward $72, industrial users and smart money investors were paying significant premiums over that price just to secure actual bars from the dwindling vault supplies. The January 2026 delivery month recorded the highest open interest in history for any minor delivery month on the COMEX exchange. Traditionally, minor months like January are quiet, with most trading concentrated in March or May. But January 2026 broke all the records because sophisticated buyers saw the vault drain and the backwardation signal and realized the window for physical acquisition was closing. They did not want a contract for March, they wanted the metal in January. This surge in demand during a period of artificial price suppression created a pressure cooker environment that is set to explode the moment the calendar flips. When you see backwardation combined with a 70% drop in warehouse inventories, you are looking at a market in the midst of a nervous breakdown. The banks have used paper silver to keep the price suppressed for years, but you cannot print physical silver atoms. Backwardation is the physical market reasserting its dominance over the paper market. It is the signal that the hunters have become the hunted. The banks are now the ones who must find metal to cover their obligations in a market where nobody wants to sell, everyone wants to buy, and the warehouses are nearly empty. The desperation is no longer a theory. It is reflected in every single trade occurring in the spot market today. As we stand on this first day of January 2026, a massive tectonic shift has just occurred in the global silver market. While the Western world was focused on New Year celebrations, the Chinese Ministry of Commerce officially activated a new export licensing regime that fundamentally alters the flow of silver across the planet. This is not a minor bureaucratic change. It is a strategic move by the world's most dominant player in silver refining and industrial processing to secure its own domestic future at the expense of the global market. Under the new regulations that went into effect today, any company wishing to export silver from China must now possess a government-issued license. The criteria for obtaining these licenses are remarkably stringent. Only 44 companies have been approved for the 2026 to 2027 period, a tiny fraction of the hundreds of mid-sized exporters that previously supplied international markets. To qualify, a firm must demonstrate a minimum annual production capacity of 80 tons. This threshold effectively wipes out the independent middle tier of the supply chain, centralizing all silver exports under the direct oversight of the Chinese state. Why does this matter so much for a silver investor in the West? Because China is the critical hub that bridges the gap between global mining and industrial consumption. While Mexico and Peru lead in primary mine production, China controls the vast majority of the world's refining capacity. In the first 11 months of 2025 alone, China exported more than 4,600 tons of silver to international hubs like London and New York. To put that in perspective, they imported only 220 tons during that same period. China has been the silent engine providing the physical metal that allows the paper markets in the West to function. The timing of this lockdown is catastrophic for the global system. Throughout late 2025, Chinese silver inventories in warehouses linked to the Shanghai Futures Exchange plummeted to their lowest levels since 2015. In October 2025, China exported a record-shattering 660 tons of silver in a desperate attempt to ease a liquidity squeeze in the London market. But that was a one-time release. With domestic stockpiles now at 10-year lows and the new licensing rules in place, China is no longer in a position to be the world's silver backstop. Beijing has signaled that silver is now a strategic mineral, essential for their dominance in solar energy, electric vehicles, and advanced electronics. Tesla CEO Elon Musk has already publicly warned that these restrictions are bad news for many industries. He is right. Silver is the most electrically conductive metal on Earth, making it irreplaceable in the green energy transition. By restricting exports today, China is effectively imposing a tax on the rest of the world's technology sector. Any silver that does manage to leave China will now be subject to state approval, meaning it can be turned off like a faucet at any moment. As the COMEX and London vaults continue to drain, the sudden removal of Chinese supply creates a supply shock that the current pricing system simply cannot absorb. The era of cheap, readily available Chinese silver ended at midnight, and the rest of the world is about to find out just how much they rely on a metal they have ignored for far too long. Today, January 2nd, 2026, marks more than just the start of a new trading week. It marks the moment when the largest pool of capital on the planet, global pension funds, begins its annual rebalancing process. We are talking about a staggering $58 trillion in assets under management. To put that in perspective, if you were to visualize the entire global silver market as a small pond, the incoming pension fund capital is a tidal wave originating from the middle of the ocean. Throughout 2025, silver was the undisputed star of the commodities sector, delivering a massive gain of 168%. In the world of institutional investing, performance like this cannot be ignored. Fund managers who are mandated to seek out performance are now staring at their screens, seeing silver as the top-performing asset of the previous year. According to standard portfolio theory, when an asset class is outperformed so dramatically, it forces a strategic reallocation. Even a tiny shift in interest, say, moving just 1% of that $58 trillion pile into silver, would represent $580 billion in new buying pressure. Here is where the math becomes truly terrifying for the short sellers. The entire annual supply of silver, including every ounce mined and every ounce recycled globally, is worth only about $35 billion at current prices. If even a fraction of the world's pension and insurance funds decide to follow the advice of strategists like those at Global X, who now suggest an optimal silver allocation of 4 to 6%, the demand would exceed the total global silver X supply by a factor of 15 to 1. There is simply not enough physical silver in existence to accommodate the institutional appetite that is being triggered by the 2025 price action. This is not a theoretical exercise. We are already seeing the first signs of this shift. In the final weeks of December, while the banks were desperately dumping paper contracts to clean their balance sheets, silver-backed exchange-traded funds like the iShares Silver Trust saw an acceleration of inflows. Institutional investors were quietly absorbing the selling pressure, knowing that once the calendar flipped to January, the regulatory shackles on the banks would be removed and the pension funds would begin their hunt. These funds are not looking for a quick trade. They are looking for a structural hedge against a decade of currency debasement and rising debt levels. As we move through this first week of January, the mismatch between available metal and institutional demand is set to create a price discovery crisis unlike anything the COMEX has ever experienced. Pension funds do not buy 5-ounce coins. They buy thousands of ounces at a time through major bullion banks. But as we have already seen, those banks are currently facing a physical inventory drain and new export restrictions from China. When $58 trillion starts hunting for a metal that is already in a structural deficit, the price does not just move, it teleports. We are watching the beginning of a massive rotation where silver is being reclassified from a speculative hobby to a mandatory institutional holding. To understand why the silver market is headed for a structural break, we must look at a fundamental economic reality that most investors completely overlook. It is called the inelasticity trap. In a normal market, when the price of a commodity like coffee or wheat rises, producers respond by increasing production to capture higher profits. This increased supply eventually meets demand and stabilizes the price. However, silver does not follow this rule. Silver is an economic anomaly because it is almost never mined for its own sake. According to the Silver Institute and data from 2025, approximately 75 to 80% of the world's silver supply is produced as a byproduct. This means that silver is essentially an accidental metal found in the same ore bodies as copper, lead, and zinc. Only about 20 to 25% of global production comes from primary silver mines where silver is the main source of revenue. For the other 80% of the market, the price of silver could double, triple, or even hit $500 per ounce, and it would not necessarily result in a single extra ounce of production. Think about the implications of this for a moment. If you are running a massive copper mine in Peru or a zinc refinery in Australia, your entire business model is built on the price of copper or zinc. Silver is just a secondary credit on your balance sheet that helps lower your overall costs. If the global economy slows down and the demand for industrial copper drops, these mines may scale back operations even if silver prices are hitting record highs. This is the definition of supply inelasticity. The supply of silver is decoupled from its own price. It is locked into the production cycles of base metals that have entirely different economic drivers. This trap is closing exactly at the moment when industrial demand is accelerating. We are currently facing the 5th consecutive year of structural silver deficits, with the total shortfall since 2021 reaching nearly 820 million ounces. In 2025 alone, the deficit was approximately 95 million ounces. In a normal market, 5 years of deficits would trigger a massive wave of new mine investment. But because silver is a byproduct, there is no silver faucet that can be turned on. Building a new primary silver mine takes between 10 to 15 years from discovery to production, and the number of high-grade silver discoveries has been declining for over a decade. The banking system and the COMEX have relied on the illusion that rising prices will eventually bring out new supply. But as we move into 2026, that illusion is being shattered by mathematical reality. When industrial users like solar panel manufacturers and electric vehicle producers start competing for silver, they are not competing against other silver mines. They are competing for a finite, fixed stream of byproduct metal. If the copper and zinc miners cannot or will not expand, the silver simply does not exist. This creates a vertical price move where the only way to balance the market is not to increase supply, but to destroy demand through prices that are so high they force rationing. We are not just looking at a price increase, we are looking at the final realization that the world's silver supply is physically trapped by the economics of other metals. As we move into 2026, we are entering a phase that economists call the era of industrial rationing. For decades, the silver market was a playground for speculators and jewelers. But today, silver has been reclassified as a critical strategic mineral. It is no longer a luxury. It is the backbone of the global energy transition and the digital revolution. The superior electrical conductivity of silver, the highest of any element on Earth, makes it irreplaceable in high-growth sectors. When the supply of such a vital material falls into a permanent deficit, the market doesn't just raise prices, it begins to break. The solar photovoltaic sector is the primary engine of this crisis. According to data from the Silver Institute and the International Renewable Energy Agency, silver consumption in solar panels has exploded, representing nearly 30% of all industrial demand in 2024, up from just 11% a decade ago. While engineers have tried to thrift or reduce the amount of silver in each cell, the sheer volume of global installations is overwhelming these savings. In 2026 alone, the solar industry is projected to consume over 150 million ounces. Unlike an investor who can wait for a price dip, a solar manufacturer cannot halt its production line. They need the physical metal now, at any cost, to fulfill government-mandated renewable energy targets. The electric vehicle revolution adds another layer of relentless demand. An average battery electric vehicle requires between 25 to 50 grams of silver, nearly double the amount used in a traditional internal combustion engine. Silver is used in everything from battery management systems and power electronics to the sensors required for autonomous driving. By 2027, electric vehicles are expected to overtake traditional cars as the primary source of automotive silver demand. When you combine this with the massive infrastructure needed for data centers and artificial intelligence, which rely on silver for high-speed semiconductor switches and cooling systems, you see a demand profile that is fundamentally price inelastic. What happens when these multi-billion-dollar tech giants realize that the COMEX warehouses only hold 82 million ounces of registered silver? We are moving toward a scenario of industrial rationing. In this environment, a company like Tesla or Samsung may decide to bypass the paper exchanges entirely and go directly to the miners to secure their supply through off-take agreements. These private contracts lock up physical production before it ever reaches the open market. This further drains the available liquidity for retail investors and smaller manufacturers, leading to a situation where the quoted price of silver on your screen becomes irrelevant because there is no metal available for purchase at that price. The final, and perhaps most critical, sector-facing rationing is healthcare. Silver's antimicrobial properties are essential for advanced wound dressings, surgical instruments, and coatings for medical devices designed to combat antibiotic-resistant bacteria. The global market for silver-based medical applications is projected to reach $5.5 billion by the end of 2026. In a true supply crunch, do we prioritize a silver coin for an investor, a panel for a solar farm, or a life-saving antimicrobial coating for a hospital? As we move past the January 2nd convergence, the competition between these sectors will become fierce. We are no longer debating a price rally. We are watching the beginning of a physical scramble where the winners are those who hold the metal and the losers are those who only hold paper promises. Today, January 2nd, 2026, we have reached the mathematical convergence point that this entire series has been building toward. The temporary curtain of the December 30th crash has been pulled back, revealing a stage where three unstoppable forces are now meeting head-on. First, the regulatory window dressing of Basel III has ended, meaning the world's 29 largest banks are no longer legally forced to dump their silver positions to shrink their balance sheets. Second, the Chinese export lockdown is officially active, severing the primary artery of refined silver to the west. And third, the $58 trillion pension fund tidal wave is beginning its annual rebalancing into the best-performing asset of 2025. When these three forces converge, the traditional mechanics of price discovery cease to function. We are no longer looking at a market that moves in percentages. We are looking at a market that is entering a phase of physical unavailability. As we have seen, the COMEX warehouses are down to just 82 million ounces of registered silver. With a global structural deficit exceeding 200 million ounces annually, the math is simple and brutal. The existing inventory can only satisfy a few more weeks of current delivery demand before the system hits a hard limit. Your strategy in this environment must shift from speculating on price to securing position. In a world where the paper-to-physical ratio is 300 to 1, owning a digital silver contract is like holding a ticket to a stadium that only has one seat for every 300 fans. If you want to be seated when the game begins, you must possess the physical metal or hold it in a fully allocated, segregated account where the title is in your name. Sophisticated investors are already moving toward physical bars and coins, or vehicles like the Sprott Physical Silver Trust, which holds the actual bullion and offers redemption features. The window for this transition is closing rapidly. As institutional capital enters the market this month, we expect to see the gold to silver ratio, which currently sits near 80 to 1, begin a violent compression toward its historical average of 40 or even 30 to 1. If gold continues its march toward $5,000 per ounce, as major banks project, a normalization of this ratio would imply silver prices well into the three-digit territory. But remember, in a systemic break, the quoted price is secondary to the premium for physical delivery. You might see silver at $75 on a screen, but find that you cannot buy a physical ounce for less than $100. We are witnessing the final act of a financial system that tried to replace physical reality with paper promises. The crash of December 2025 was not the end of the rally, it was the final clearing of the deck before the structural squeeze of 2026 takes hold. The math is clear, the inventories are empty, and the regulators have removed the bank's ability to hide. Position yourself on the right side of this structural break before the window closes entirely. This is not just a trade, it is a fundamental realignment of the global monetary order.